Welcome, ladies and gentlemen, to Commodity TV and a new edition of our online interview series. We want to talk to Mark Learmonth, the CEO of Caledonia Mining. You remember, largest gold producer in Zimbabwe and really successful. Mark, good morning to Zimbabwe. How are you?
Good morning. Good morning to you, Jochen.
Yeah, great to have you here again. And I'm a shareholder of the company. And by the way, you just paid your 40th quarter consecutive dividend. Thank you very much for that. I really appreciate because I always love to have it into my account. That is great.
Jochen, let me let you know. I'm a shareholder as well, and I
Yeah.
like it in my account as well. So I think we're on the same page here. Yeah.
Definitely. We like to have those bookings into our account. That's great. Super. I went through your Q3 news release. We want to talk about Q3, but first of all, congratulations, because I saw one sentence in your comment. Blanket is now operating as expected, having achieved record gold production in the quarter. So that means now we are full on track, right?
We are. So as you know, it was a record quarterly production in Q3. And let's be clear, the things we had to address weren't rocket science by any means.
Mhm.
It was just basic on-mine supervision and fairly low-level management, trying to get the people, literally at the face to go about their jobs with the appropriate degree of care and attention. So it took slightly longer to turn around than we'd expected, but certainly our production is where we expect it to be. Okay.
Mhm.
Now there is the only sort of irritating thing that we need to attend to is that in two areas, operating costs are slightly higher than we expected.
Mhm.
The first is in the area of electricity, and the second is in the area of labour. And on electricity, the issue is we are using more power than we had anticipated. It's not because power prices have gone up, in which case there's not much we can do about it. So as the miners sort of developed over recent years, and we put in more infrastructure, we've got to focus much more on them curtailing the use of infrastructure that is now redundant, so that we can bring our overall electricity consumption down. Because don't forget, I mean, in Q3 2023 that's a fairly comparable quarter to the whole of 2022. 2022 we did about 80,000 ounces. 2023 was a record, but it was about the same running rate of 80,000 ounces a year, slightly more. So it's not as though we're hoisting more material than we were in 2022. So someone's got to explain to me why we're using more power to do that. So
Mhm.
that's one area where we need to give it close attention. And then the second area is the area of labour, where again the inflation we've seen isn't due to inflation on labour rates. It's due to less efficient use of labour, in particular higher than expected overtime rates, which again, I'll take you back to the point. The mine is not producing at a level which is higher than it was for the whole of 2022. So why all of a sudden are we having to pay more sort of overtime? So those are two areas that we need to focus on to try and get those costs back to where we'd like them to be. It's not a train smash by any means. It's not a train smash,
Mhm.
but those are the two areas I think for focus as we go forwards.
Mhm. So you think the $1,268 per ounce AIC for the group, that is something which is more on the top side, because I think
Oh, absolutely,
it really reflects
absolutely.
also costs for
Oh
Bilboes,
yeah,
right? And
it's
Bilboes is now
absolutely.
care and
Yeah.
maintenance, right? Okay, super. So
Yes.
that
So
means
look, I
we.
mean, to go back to Bilboes,
Mhm.
Bilboes is currently costing us about $1 million a month. That will go down to about $200,000 a month
Mhm.
when it goes on to care and maintenance, which is just the cost of security, just keeping the integrity of the place. So that, yeah, we will expect to see those costs come down. And as of now, actually, I mean,
Mhm.
the thing went on to care and maintenance the first
Mhm.
of October.
But you are still leaching from some tailings
Yeah,
there,
yeah,
right?
we are, but don't expect large amounts of gold to come out of that. That will so
Mhm.
it should broadly be cash neutral. I'd have thought, certainly
Yeah,
for
but that's not
Q4.
bad.
It's fine, it's fine. But let's be
Exactly.
clear. Let's be clear. We're going to talk about Bilboes in a minute. I don't want
Mhm.
people to get sidetracked
Mhm.
with the oxide project. The oxide project is not what we're doing about Bilboes. Okay,
Mhm.
Bilboes is
Okay.
about the deeper sulfide project.
Yeah.
Maybe
Yeah.
we'll come back to that in a moment.
Absolutely, because exactly before we come to Bilboes, I also want to ask you about Eroica, because you had good success in exploration
Mm,
underground
mm.
also. So would that maybe also enlarge the mine life?
Exactly. No, we'll do very
Mm,
much so in due course. So we're mining. We're exploring in sort of two areas. One sort of on the left hand side of the mine, or the northern side. Another one on the southern side. So the Eroica is on one side. We published those results
mhm,
probably about 2 months ago now, and
mhm,
it's, I think, probably about two thirds of each hole we drilled came back better in terms of grade and
mhm,
width,
mhm,
which is excellent. And currently we're targeting area, that a part of the mine which is above the bottom, at the current bottom level. So the mine goes down to 1200 or 1206 meters or something. We're exploring above that. So any
mhm,
material that we find will in due course be included in a resource upgrade, and will in due course be included in a revised life of mine plan. And you're quite right, that will extend the period of time
mhm,
before we need to take the mine deeper. And I think it's fair to I think it's clear to sort of try and emphasise this point. As far as I can see, unless something very special happens, really, I think Blanket will be operating at sort of 75 to 80,000 ounces a year, for as long as possible,
mhm,
so that we're using the existing infrastructure to increase Blanket's production significantly above 80,000 ounces. Is probably going to require a disproportionate investment in expansion infrastructure, new mills,
mhm.
new CIL tanks, new sort of infrastructure for an increased number of workers. It's quite you've not been to the mine, but for some reason, it's in quite a constrained geographical footprint in quite a narrow valley. And we are beginning to run out of space as to where we can put more stuff. So my feeling would be to try and stabilise Blanket at 75 to 80,000 ounces a year.
Mhm.
Keep a close eye on those costs, and
Yep.
extend Blanket's life so it's a long term cash generator.
Yeah, absolutely. No, that's super. Just coming back shortly to the power, because I saw also that you are negotiating on an additional solar plant. So that
No, no,
would
no, no,
also
no.
help a lot.
No, we're not actually. The solar plant. Don't forget, we funded the solar plant ourselves using
Hmm.
equity, because it was kind of mission critical to ours. We had to get this solar plant
Hmm.
in to reduce our reliance on the grid and to displace diesel.
Hmm.
And we frankly didn't trust anybody else to do it, because Zimbabwe is a bit of a difficult place to operate in. We know how to do it. We didn't want him in a position where some massive international conglomerate says, "Oh, we'll do it for you," find it too difficult, and then just don't deliver. It was too important for us to trust it to somebody else. So we funded it ourselves. It's actually running slightly better than planned, which is
Hmm.
excellent. But we don't need to own it. So where we are is we've received offers for the plant, and hopefully we'll be in a position where we can finalise a sale transaction whereby we realise the more than the capital we put into it. We spent
Hmm.
14 million. We should get more than we paid to get when we sell it, but we'll still benefit from the cheap power. So we don't. We're in the business of developing and operating gold mines. We're not in the business of owning infrastructure projects like that. So if someone's got a cheaper cost of capital and
Hmm.
they can pay more for it than we paid for it, we can release the capital
Hmm.
and use it elsewhere in the business.
Okay, but would you enlarge then the plant if possible,
Maybe,
or the
maybe,
buyer or
maybe
whatever?
absolutely, the buyer is buying this with a view to increasing its
Hmm.
footprint in Zimbabwe. So absolutely, if we find that we need more power, we can certainly expand that project. On the power situation, the other development is that we now import power directly from either Mozambique or Zambia, between the two. Now,
Hmm.
whilst that doesn't necessarily benefit us in terms of reduced power outages, because that power still has to go through the grid, and
Hmm.
Blanket, unfortunately, is in a particularly poorly served part of Zimbabwe from a grid perspective. So we still
Hmm.
get difficulties with the grid power, but we do benefit from a slightly lower tariff.
Hmm.
Now, there's other very technical stuff we can do to
Hmm.
try and um, improve the overall electricity situation. But pretty much, I think we've got our arms around the electricity now with the solar project running and the full set of diesel
Hmm.
generators.
Super.
We can. I think we're not at risk from power as we were,
Hmm.
say, 2 or 3 years ago.
Okay, super. Yeah, then let's come to Bilboes, because you're working on that, yeah, I call it updated feasibility study,
Hmm.
because you want to do it now phased. What is the
Right.
status now?
Right. So let's be clear. There is an existing feasibility study. It's out there. It's on our website. It was prepared by the vendors, and there's
Hmm.
absolutely nothing wrong with it, other than the fact that the vendors, as you know, as sort of selling an asset, were interested in optimizing the size of the project with a view to getting the best price. And that feasibility study can quite easily be updated, to reflect the current environment. Our approach is we'll look at that, we're updating it, and we'll look at it, because it may have validity, but we're increasingly coming to the view that actually the best way to approach this from the perspective of maximizing Caledonia's NPV per share is to adopt a slightly slower phased approach whereby you build first phase project and say anything between 60 and 80,000 ounces, which is cash generative, and then you recycle the cash from that first phase along with the surplus cash from Blanket to construct phase two. And the whole objective here is to balance growth and minimize dilution. Because the curse of the mining industry, the gold industry in particular, has been unfettered equity dilution. And you're a shareholder, I'm a shareholder. There's no point in us doubling the size of the business or tripling the size of the business and doubling or tripling the size of the number of shares in issue because we just stood still. Okay. Now
That would
that
be appreciated.
phased approach is effectively a brand new feasibility study, which requires new pit designs and really from first principles. That is that's a longer process than simply rehashing an existing body of work. So whilst the existing feasibility study, we could probably get that finished by the end of the year, we need to compare that to the work on the new smaller project, which probably won't be in a finished state until the first quarter of next year. And that's what takes slightly longer. But frankly, it's all about optimizing NPV per share and minimizing dilution for the benefit of shareholders.
Super, and keeping the dividend.
Absolutely, yeah. No, it's fair to say we do have two very clear investor constituencies. One half who are very wedded to the dividend, and the other half who, frankly, aren't so interested in the dividend. And frankly, we got a balance between those two. And that really comes down to, again, a broader issue of capital allocation, which is something we'll consider as we go forwards. Okay.
Okay, super. So then let's talk shortly about the balance sheet, about money. I think it was a very good quarter, right?
Yeah, look, the cash. The really nice thing about the quarter was cash generation. Now, production was a record. I've said that costs were somewhat elevated, but we could address that. But they were very strong cash. I think it was like $15 million in the quarter. So we were helped by, for once, a reversal in sort of working capital. We worked quite hard to manage our working capital. So the cash generation was very strong. It's fair to say that in the quarter we continued to spend very heavily, particularly on a new tailings facility. As we've increased the rate of production at the mine now to 80,000 ounces, and as over the last few years the grade has been slightly lower, that means we're now mining and processing about 2,400 tons a day, all of which has to go on you have to put it somewhere. It has to go on a tailings facility. That is now getting towards the end of its life, and we had to run quite quickly to get the new tailings facility in place so we could start depositing on that a couple of weeks ago. And sad to say that in the new world, tailings facilities are much more expensive because they've got much more in the way of environmental protection. Not for a minute saying that our existing tailings facility is environmentally unsound. Not at all. It's just that you've got to do more to
make it right. Yeah.
To keep people happy. And so it means the new tailings facility is double lined, a combination of clay and plastic, and that will cost about $25 million. $25 million. That's probably the world's biggest. Well, it's not the world's biggest sandcastle because there are other big, but it's a very, very, very expensive bit of kit. We got no choice. If we don't have somewhere to dump the tailings, we can't continue production. So that we started pumping on that a couple of weeks ago. So the immediate sort of production risk has gone away, and there is some more spending on that for the balance of this year and into next year. But we should be looking at capex coming down, and hence our cash position should start to improve. But don't forget. We've spent over the course of the last few years, we've spent a lot of cash on strategic things. So we bought Motapa for cash, $8.25 million. When we bought Bilboes, there are a lot of cash costs associated with that. Some time ago, we bought Marley Green for cash. So we have moved the business forward quite substantially in terms of putting together the portfolio of assets we want in Zimbabwe, using internal cash resources with some modest equity raises.
Okay, super. You just mentioned also Marley Green. Is there something going on, or
Yeah,
is just you
Marley
saying
Green,
we have time?
Marley Green is very much on the back burner. It's been overtaken by events. There's nothing wrong with the asset. We bought it. It had 1,000,000 ounces of inferred. We've upgraded half of that to M&I. The grade's perfectly good. It's got good exploration potential. But I'm afraid it's now become sort of overtaken by events, overtaken by the Bilboes and Matapa assets.
Hmm.
We may consider joint venturing it from an exploration perspective, or potentially a smaller scale production. But frankly, for right now, that's not a main priority right now.
Yeah, absolutely. Okay, super. Well, that all looks good. Anything to add?
No, it's been a difficult start to the year.
Mm,
So hopefully, there's always a time lag before you get the news out. So as I say, quarter three was very strong. Quarter four is looking okay. So yeah, hopefully we can maintain this momentum into next year and start making some demonstrable progress
mhm,
on Bilboes.
mhm, super. And you are still net debt free, right?
No, we got small. We got some small. We got about our cash at the end of the quarter was sort of negative $3 million, I think.
Mm,
Most of that debt, so we got about $13 million of debt in Zimbabwe, and we got cash outside Zimbabwe. That will improve as we go forwards.
mhm.
That will improve.
So,
So
but it's
as I say, the cash the cash this year has been adversely affected by the
mm,
cash hemorrhage at Bilboes, which was
mhm,
stopped. The poor performance of Blanket at the first half of the year was
mm,
disappointing, but then we had no choice. We've had to spend a lot of money on this tailings facility, so
mhm.
it's
Yeah,
not been comfortable from a cash
yeah,
perspective. But it's not structural.
yeah.
It's a short term phenomenon.
But how long will the tailings facility then can be used?
14 years.
Oh well, that's okay. Yeah. So
14 years.
okay, that's
Way
fine.
way beyond way beyond our horizon, Jochen. Way beyond our.
Okay. No, that's super. Perfect, Mark. Thank you very much for the update. It all sounds really, really positive, I would say. And yeah, again, thanks for the dividend and wish you well.
Good. Thank you, Jochen.
Thank you. Yeah, ladies and gentlemen, that was Mark Learmonth, the CEO of Caledonia Mining. And you heard it, company is full on track. Everything is really up and running. Problems are solved, which they had in the first half of the year with Blanket a little bit producing lower. But this is all done. This is all fine. The company is a cash machine, thank God. But of course, they had to really invest into that tailings, yeah, into those new tailings facility and $25 million. But as you heard, this is for a long, long time then working. So that is all fine. So I think also those investments will go down significantly by the mid of next year. And yeah, with Bilboes, we will see phased approach. I like because it's not putting anything too large on risk. Also lower capex. This is fantastic. But then future production quite fast. This is how it should be. Check out the company. It's a fantastic dividend payer. You would like it. Thanks for watching us and bye bye from Switzerland.